We're taking a transaction between the two parties and we're inserting an independent third-party trust. In this case, it's a business trust. We're doing an installment sale between the seller and the trust, which essentially means we're not only selling the property or the asset to the trust, but we're also being the bank. We're saying, okay, I'm going to finance this purchase to the trust. I'm going to take back a secure promissory note, which means a promise to pay, so I'm going to get my full amount of my net proceeds over time in the form of payments. And this is called IRC, or Internal Revenue Code 453. Essentially what the law allows is when you sell an asset and you sell or finance it, you're deferring the taxes on the sale and you're paying taxes only on the payments as you receive them. So we're setting up the structured installment sale. We do need to do this before the closing occurs. And then the trust, once it acquires this asset via installment sale, it can sell it for cash to the buyer, and that's what funds the trust, is the money comes into the trust because the seller has sold their interest in the asset to the trust just before closing. In exchange for this note, they're deferring their tax bill. But we don't have the risk that normally comes with seller financing, is where if the buyer bought it and you seller finance to the buyer, who knows what they're going to do with the asset, right? They either know what they're doing or they don't. So this removes that risk, and so the buyer pays cash for the property, or mostly cash, and then there's some installment payments that come into the trust. From there, the seller can approve how they want the money invested. In a nutshell, structured installment sale designed to defer the taxes, where you can receive income and only be taxed on that income.